Great. So if you object, Joe or Kale, speak now or forever. Well, anyway, you're stuck. All right. So welcome to our webinar on today, the 12th of August, 2026. It's been a little while since we've done one of these. I think April was our last one, and we wanted to take the time to connect with all of you on a few things that we think are important and timely. We've gotten some questions that you'd like us to answer, but we wanted to begin with a little discussion about what's happening in the firm. Some of you may or may not have seen communication from Commonwealth regarding the purchase of Commonwealth by LPL. LPL is, like Commonwealth, a registered investment advisor and broker-dealer that provides services, is a business partner to independent advisors like us. And so we have been affiliated with Commonwealth for 17 years. It's been an excellent partnership. For much of what we do, the work that they provide or the services that they provide are not readily apparent to our clients, but they do fulfill a very important role. Our relationship with National Financial Services, our custodian, is through Commonwealth. Commonwealth monitors our behavior to make sure that we are obeying all of the applicable securities regulations and ensuring that we do what we're supposed to do on our end. Likewise, they provide helpful services to us. And so when it was announced that they were being acquired by LPL, we were frankly surprised because we have appreciated the private ownership of Commonwealth for many years. But the founder reached a point where liquidity was attractive, and that's why we found ourselves in that situation. So once the surprise wore off, we started looking around to make sure that we were comfortable with this acquisition. We spent the next several months reviewing many different companies that provide similar services to Commonwealth. And let's see. I'm hearing that the audio is bad. All right, let me try something else. Sorry about that. All right, Kale, you're gonna have to give me a thumbs up if it's better or worse. Better or louder?
It's better and louder, yeah.
Okay, great. Yeah, sorry about my headset, I guess, is not doing its job today. So anyway, I was giving my monologue about the LPL thing and how we spent some time really trying to understand what other options were out there, because it's not something we've had to investigate for a while. And so after a lot of deliberation, we felt like it was important to, like the best option for us is to stay with Commonwealth. Commonwealth is going to operate as what they're calling a portfolio company of LPL. At least for the foreseeable future, it will continue to be Commonwealth just under the LPL umbrella. And we're comfortable with the number of key people that are remaining at Commonwealth that have signed retention offers there. Anything you want to add on that, Joe Senior or Kale?
No, I think you've said it very well.
So what does this mean for you? Well, one of our major concerns was, can we continue to provide the same service that we have to our clients? And we're confident that we can, especially because Commonwealth will continue to exist in similar form to what we've enjoyed. What does it mean for all of you? It should be a very, very low level of effort, except for a couple of key things. Number one, nothing is going to change for any of your accounts or any of the way we work with you for at least a year. In the fourth quarter, right now it's projected for the fourth quarter of 2026, client assets will move from National Financial Services, where they are currently custodied, to LPL. LPL is a self-custody firm, meaning that there's not another entity between Commonwealth and LPL. Or between like right now with Commonwealth, we have National Financial Services that holds the money. LPL holds the money. So in some ways, it will streamline some of the operations that we use to send money to clients back and forth. So some of what we do will actually be, we think, easier with LPL than it is with Commonwealth. And the time frame for certain requests will hopefully be shortened. We're not expecting a significant amount of forms or other things that will have to be signed. There are some cases where that might be the case, but we will know well in advance if anything needs to be done to make that as seamless as possible. So you're going to get information from Commonwealth/LPL really starting in the spring of next year. At that point, it is what's called a negative consent situation, meaning that you can certainly opt out, but the default provision is that you will proceed with this transfer of accounts from National Financial Services to LPL at some point in the fourth quarter of next year. Hopefully that makes sense. If you have any questions about that, we are certainly happy to talk about your particular situation and what it means. But again, it's well over a year before we expect anything to happen, because for that transition to be as seamless as possible, they have to make sure that everything lines up appropriately. So,
Joe, can I add in here?
yeah, go ahead.
I think, one of the key factors, and certainly not the governing factor, but a very important factor was that this transition is going to be extremely seamless from the standpoint of not having to go through a lot of signing, again, account agreements, signatures, and so forth. It will be very smooth in that regard. Had we opted to go with a different, firm, it would have involved a lot of administrative work. And we just, for what we saw out there compared to what we are offering currently and what we will be able to continue to offer, which will certainly be no less, if not more, than what we've been offering in the past. That was certainly a consideration. And I think for you as our clients, making things as seamless as possible is always a goal. So.
Yeah, one of the things that will change is how you access and view your accounts. So right now, Investor 360 is the portal that we use for secure messaging, to link outside accounts, to look at the accounts that we're directly managing for you. LPL has their own portal for that. So getting that set up will be something that we'll have to do when that time comes. But it should be essentially an overnight transition so there's no interruption in access to funds. I think the expectation is it will happen on a Friday evening, and by the end of the weekend, everything is good to go. So a couple of questions have come related to this. One is, will LPL offer any features or services, additional features or services to all of you as clients? I would say yes, probably. We're still learning some of those things, and they are similar to what Commonwealth has been moving toward, particularly through Investor 360, making it easier for you to be able to move money in or out of accounts. Right now, as you're probably aware, if you want to take a distribution or put money into the account, really all of that has to happen through our office. I think LPL has the ability for you to be able to upload a check directly to an investment account. So that would save you from having to send that to us or drop it by the office. So that's one small thing that can be a helpful way of speeding up the deposit of money to an account. But as we learn these things, I'm sure we're going to have more time providing education about what additional things might be helpful. Another question about whether there'll be additional modeling tools and things like that. Right now, we anticipate we'll continue to use Right Capital. That's the financial planning software that we use primarily. That will continue to be our tool of choice for that purpose. LPL, I think, has some things, but that it's probably a little bit less powerful than what we have used with Right Capital. And that tends to be the case for financial planning software. Financial planning software company is generally going to have a better offering or a better tool than something that is provided as sort of an included feature. What Commonwealth has something we've never really used, which is a very basic tool. I think LPL has something similar. So from a modeling and financial planning standpoint, we're going to continue to use the software that we use today, unless something great comes along. All right. Let's see if there's another question along those lines. Yeah, we don't anticipate it's something that's going to affect you certainly not in any negative way. We're actually kind of excited now, having spent all this time, like Joe Sr. said, looking at everything else that's out there and realizing we're in a very good place. And the key thing is we maintain our independence. There are some companies that are out there and they're willing to provide really nice financial incentives, but almost all of those arrangements would limit our independence in some way. And we're just not comfortable doing anything that would make it harder for us to have flexibility and independence as your advisors. So, LPL is buying Commonwealth. They're not buying us. They're not going to be telling us how to run our business or what to recommend to our clients. So that independent component is still really strong and the reason why we feel comfortable. So anything else to add, gentlemen?
No.
Yeah, I think there's some things like the new app that they'll be using, the LPL will be using. I think that's probably better than Investor 360. So I think that'll be better from the client side of things. There's also some small changes, like if you're to add a new bank account to your account, I think to get a new bank account linked where we're at now takes, several days. And I think it happens significantly faster with LPL. So I think from the client side, I think almost everything's going to be better. On our side, obviously there's going to be, little headaches just making the transition, but that's kind of our problem, not the client's problem. And I think all the clients will actually be, kind of pleasantly surprised with some of the stuff going forward.
Yeah. Agreed. So as we learn, especially if there's anything really cool, we'll share that with you as well. All right. So we did have a couple of other questions. So let's go through those. Let me find the list. All right. So, well, let me highlight one other thing really quick. We mentioned this in the lottery letter a couple of weeks ago, but online scams, whether they are email, text message, AI connected, are not going anywhere. If anything, they're becoming more sophisticated and are more of a challenge. We have had a number of clients directly affected by some kind of scam. Fortunately, not originating from our office, but bank accounts or other things that have been compromised. And almost always, it's not an anonymous person, hacking into your computer in the way we kind of think of it in the movies. It's some amount of what they call social engineering. You answer a phone call or a text message or an email, and they're able to get some kind of information from you that you should not have shared, but they're very, very good at seeming on the level. And so it's an easy thing, particularly for older clients or people who are less aware of the vulnerabilities of these kinds of things. So we would urge you, if anyone asks you for money and it's not somebody you know, or even if it's someone you know, but please don't hesitate to call us or email us, even if you just need a second opinion. The enemy of good financial decision making is urgency. If someone is making you feel like you have to respond financially in an emergency, that is a huge red flag. And that's usually how they prey on people, is making you think that some transaction must be executed immediately. And if you don't do it right away, and if you don't do it while they're on the phone with you, that you're going to deal with some kind of criminal or civil liability. You'll be sued, or you'll get a ticket, or you'll be arrested. These are all things that are happening. And so we just have to be really, really vigilant and make sure that we don't talk to anybody that we don't know or trust. So that was just something we wanted to highlight. We're going to talk about it a lot because it's becoming more and more of a challenge.
Joe, I failed to mention this, but when your mother and I were over at Jacksonville recently, it was at the Mayo Clinic doing physical, and we were waiting for the valet to bring the car. And there was a woman not too far from your mother who was speaking on the phone very frantically and was quite aggravated, nervous, an elderly woman. And one of the hospital personnel came up being concerned that, with her demeanor, and she was being scammed. She was on the phone. A gentleman was trying to get her to give him her account number. And she was saying to him that, my sons have all this information. I said, well, we need the information now. And frequently in those situations, as you mentioned, there is tremendous pressure placed on the victim. And the person on the other end is posing to be either an officer of the government or even a financial institution. And they will get people worked up to the point to where, they feel like their world is coming to an end. So fortunately, in this case, the hospital personnel were able to, take the phone and give the commands to the person to cease and desist. But to have it that close, just 6 feet away was interesting. But it's very pervasive. Yeah.
It goes from something you're just hearing about to something you've seen.
Right. Yeah.
Anything important enough, any matter that is legitimate and important, the person on the other end of the line should be able to give you a phone number that you can independently verify is legitimate. So please use us as a resource. It's never going to be a waste of our time to help talk you through something, even if it ends up being a legitimate thing. 5 minutes is worth the time. So great, thank you. All right, let's see. On to our questions then. Okay. Let's start with this question, maybe just a little bit of a market outlook for the rest of the year. What are your thoughts? Maybe we can start with all the standard caveats. We don't know. We can have an idea about where things might be headed, but it's just really, really hard to know what may happen based on all kinds of factors. But this question comes particularly because of reports that the market may be overvalued. So let's talk about that a little bit. Is the market overvalued, and what does it mean for the rest of the year? Cale, do you have any thoughts on that? I hit you with a good one right off the bat.
I think if we, asked this question earlier in the year when the market was down, 20% or so, I think we'd be very surprised at where it's at now. I would say, the valuations are higher than they were earlier in the year, but, also corporate earnings have been really good this year. So the valuations are kind of climbing with the earnings. There's definitely some companies that are extremely overextended. You probably can't name them individually, on the call, but you probably hear their names a lot on CNBC. But then there's also quite a few stocks that we kind of view as fairly valued or even undervalued right now. So you can tell things are definitely going up in price and things might be trending toward expensive, but it's hard to say that things are, nosebleed overvalued right now and ripe for a correction without some sort of outside stimulus.
It really underscores the need to be diversified and to follow prudent investment principles. It's very tempting to follow or to chase the returns of the things that have been really compelling. And now it can be tempting when things have done well to think, okay, maybe I want to park my money and wait it out. The difficulty of timing the market is not any lower now than it was before. And really the risk of missing out on meaningful long-term economic growth is pretty high. So I agree with you, Cale, that earnings have been good. They definitely seem supportive of the economy being in a growth mode, even if it's a slower growth mode. But anyway, Senior, what are your thoughts on that question?
Well, I think you hit the nail on the head right off the bat with just, being diversified, number one, always looking for quality. And, as Cale indicated, there's some stocks right now that are maybe possibly overvalued or highly valued, but there are many others that are not. And it remains a matter of just doing your homework. In my many years of doing this, I have never, ever once seen anyone benefit from sitting on the sideline, ever. Because mathematically, it doesn't prove out over the long haul the advantage of staying in the market, remaining, well diversified, and staying the course has always paid dividends, and clients have always benefited. So I don't know that we've ever advocated, a pullout in anticipation of jumping back in, because the minute you think you know when to pull out, you're presuming you're going to know when to get back in, and that's even more elusive. So that's my take.
And you have to cope with, do you have the wherewithal emotionally, psychologically
Sure.
take that risk once you've already, stepped aside?
Yeah.
Yeah, imagining, making a big move out of the market when the sweeping tariffs were announced at the beginning of the year, or towards closer to the beginning of the year, or saying, okay, I'm gonna sit out and wait until things get better. Well, things got better very quickly, as it was clear that those tariff amounts were a highly negotiable item. Um, and then surprising things happen. For example, the performance of international stocks have been much better this year than they have been in the past. And for a lot of the year, outpaced US stock performance. That US international stocks have struggled a little bit last month, but still relative to where they have been, they've been much more attractive. And so that comes back to that diversification piece. And we're all a little bit sick of the topic, but I think we do have to touch on tariffs a little bit. Um, the right now, the projected, I think, global tariff amount is something like 14% or 12. Now, of course, that I say a statistic, I'm going to get it wrong. But let's see, maybe I probably can't find it now. But we should expect them, now that they've sort of settled into an amount that seems like a decent long-term number. They're at least 10 points higher, 10% higher than they were a year ago. And that's going to have an impact on all kinds of areas of the economy, global and domestic. And so that's likely to keep inflation higher than the Fed would like. And that would indicate that they may keep rates at or near current levels, which not everybody in the government is happy about. So, but in the meantime, at least, it is something that now seems to be at a point that we can, they're not going away. We're not going back to 2024 tariff levels. They're going to be higher than they have been in a long time. I think we can definitely agree on that. So that will have an impact on all kinds of things, and we're still learning what that is. Any other thoughts on tariffs?
No.
Everyone's favorite topic.
No.
What Kale dreams about, tariffs. All right, great. Other question. In light of the inflationary impact of the national debt and continuing federal deficits, what about tangible assets like gold, silver, etc., or even Bitcoin as a hedge? Any change from your previous opinions? And I guess we're probably on the not huge fans of some of these things I don't know. It's a complicated question, but any thoughts on that, Senior?
Well, I go to Bitcoin first.
Be careful. Remember, it's still a tricky.
Yeah.
I don't have to edit this video before I put it on YouTube.
Regarding the Bitcoin, the problem there is it's an unregulated area. And so you have no knowledge of who's pulling the strings when or where. There's really no managerial or administrative or corporate accountability. So it's a very high risk consideration. And obviously for those reasons, we don't promote them here, from a regulatory restricted point of view. But otherwise, again, over the years, metals have been very attractive, but have they outpaced the overall performance of the market over comparable periods of time? No.
I mean, it depends, right? If
Yeah.
you're lucky on the timing, yes. If you're
Yes.
unlucky, no, right?
But over the longer haul, the curve flattens out, and it's tough. And as I've said many times, I don't want to be the one. If there is the ultimate crash, so to speak, I want to make sure I have food stored away so I can eat. And you can't eat gold. If you have bread lines like they did after World War II, and you're in the bread line and you've got a pouch full of gold shavings and you walk up to get your ration or whatever, you're not going to make it home alive. And if you do, they're going to chase you home and ask you where the rest is buried, and then they'll kill you. So, it's we have an established economy. We work with what we have. We do the best with what we have. And do we want to keep some of that as a hedge? Absolutely. Is there a harm in that? No. But to rely on it fully, it's buy food, source food. So,
Okay, what are your thoughts on that question?
No, I mean, I just threw some rice out of my pantry that had some bugs in it, so I don't know how much food you can really store for the long haul.
You need
I
to
mean,
can it.
I mean, gold's interesting. I mean, I have the gold chart up right now. I hear a lot of people say that, it's a good inflation hedge. But when inflation was at its highest in 2022, gold was actually going nowhere. And then when it started cooling off, gold's about doubled since that point. So when we're at a period of lower inflation, it's actually done significantly better than when we had high inflation. It kind of reacts, I think, more to the real interest rate than it does necessarily inflation immediately. When we had high inflation, the Fed raised rates, and so you could basically get risk-free return on your cash over 5%, with a treasury or something like that. And then so that kind of made gold really lose its appeal. I think there's like 2 rate cuts that are forecasted for this year. So now, yields are coming down, and now that's when the gold is actually starting to increase in value. Um, and then if you look at some of the other assets, like the S&P 500, some of the international markets over the past, 5 years, they've done just as good or better than gold. And you can actually get, some earnings, some dividends off of those. There's no yield on gold. And I'm not exactly sure how real estate is compared to it, but I'm sure real estate has done well as an inflation hedge also. So, gold's not something I'm necessarily against. It's just I don't think the advantages are so clear there that it makes it worth, doing over something else.
Yeah, thank you, both of you, for sharing those thoughts. It makes a lot of sense. And really there's a key differentiation between the bond or stock markets and some of these holdings, which really are commodities. The companies we invest in, we can determine an appropriate price. People may differ in opinion about what that price should be, but there is an underlying, maybe it's a combination of the assets they own and the forward-looking earnings and those kinds of things that would determine what an appropriate price for that is, where it can be hard for commodities, and particularly some of the risks of things like cryptocurrency is that it is largely based on an expectation that somebody after you will pay more than you paid for that commodity. And absent, there's not a model that can really help you determine whether the current price is a real reflection of the value of that asset. So that's why those continue to be areas that, while seeming kind of, in some cases, they're touted as being safer. You can have just as much volatility in any of those assets, and sometimes more, as you have in like a broad market index fund. So, but a good question, and reasonable to wonder, given everything going on, if there is some better place to keep things. All right, so let's talk a little bit about the cost of medical care. This is something that is definitely on people's minds when we do financial plans. When we look at the price of things in the future, there's 2 things that have historically increased in cost much more quickly than anything else. That's healthcare and education, higher education. Fortunately for people with kids nearing college age, myself included, some college expenses have tapered a bit. Some of that inflation is cooled, but healthcare expenses still seem to be cooking. So how can people on Social Security and Medicare, how can they hedge against the higher costs of healthcare, especially if there are changes to the way Social Security is administered? Any thoughts on that? How do you hedge against medical medical expenses?
Well, when we do our financial plans, we have a pretty high inflator in there when we forecast future medical expenses, and typically when we do them, we also forecast 2 years of very expensive long-term care expense at the end of the financial plan. And then of course we backtrack from there and try to make sure that you're invested in a manner that can afford those expenses along the way. So I think you know having a good financial plan and if you're young enough, saving diligently, I think is probably the best way to hedge against those future expenses.
Yeah, Senior, any thoughts from you on that question?
Well, just following along what Cale said, the importance of tying into long-term care insurance, again, depending on your financial health at the time, the earlier the better. And because the premiums go up, and many times we see clients or people will come in, prospective clients, and they've made no provision for long-term care coverage, and they're at a point where the costs have become very prohibitive. So I think as early as possible in one's life to begin looking at those and to acquire, or at least to research that coverage and to put it in place is very important. And again, we're at in our family, we see that with, your mother who was diagnosed with rheumatoid arthritis at age 40 and became uninsurable at that point for long-term care. We don't know when these things are going to hit us, and we tend to think that, we'll wait till we're in our late 50, 55, 60, when in fact a chronic illness can hit a person anytime. And so the wisdom in at least looking at it and considering it and putting it in place, I think, is very important.
And that's something we can help you identify is, are you in a position to self-insure? If you are not, here are the options to manage that. And even when somebody has the resources to fully cover anticipated health care or long-term care expenses, it is sometimes hard to spend the money. It's sometimes hard, even if you have the money, to spend the money on something, because you might think, well, I can handle this. This is something that I don't want to cut into my assets and put myself in any kind of danger. So those are questions that we can help answer through what we think are some prudent assumptions about the cost of things moving forward. We should also say that we think it's very unlikely that there will be meaningful changes to Social Security for any Social Security recipients. The things that are more likely to happen, and all of these are educated guesses, but there are things that the government can do, changes they can make to Social Security in particular, that would not affect any current recipients. And that's almost certainly going to be the case because Social Security recipients, this is one of the most brilliant things that Franklin Roosevelt did as president, was take a group of people that had no real connecting political, ideology and put them all under the same government benefit. And now when Social Security issues come up as a group, that's the most reliable voting bloc in the country. So lawmakers are unfortunately, they lack the fortitude to confront this in the way that they should, because they know they have a little bit of time. But at some point, it's more likely that they would extend the full retirement age from the current age of 67 to something like 70, maybe for everybody under age 50. They could increase the amount of Social Security that is taxable. Right now, only a maximum of 85% of your Social Security benefit can be taxed. They could introduce some kinds of means testing, which would be difficult to do, but not impossible. So there are a lot of things they could do that are without affecting any existing Social Security recipients' benefits, because that would be so dangerous politically for them to do. So certainly for your younger folks, and if you have children in that working age, banking too much on the same level of Social Security or the same timing of Social Security as their parents and grandparents is something we would probably avoid. But it is something that has to happen. So in the meantime, doing an appropriate analysis to see if you're prepared for the stuff that may happen is important. The other thing to keep in mind is older individuals do tend to consume a lot of and create a lot of healthcare expense or use healthcare a lot, but often are not the direct payers of those healthcare expenses. Instead, that is insurance, Medicare, and so forth, that has that absorbs a lot of that out-of-pocket expense for retirees. Any other thoughts on that, either of you?
Well,
all right. If there are any other questions, speak now or forever hold your peace. We didn't want to take too long today. So that's what we have received thus far. Hopefully it's been helpful. And if there are other things that you would like to discuss, please let us know. Send us an email and we're happy to chat. We really, really appreciate your confidence and are grateful to those of you who are watching now. And oh, here we go. Another question. Great. This relates to 529 accounts. What are the benefit of 529 accounts with new changes or changes that have happened? Are they still worthwhile? Who wants to go first on that?
well, I'll go first. I mean, certainly they're beneficial. I mean, of course, you're putting in after-tax money, but the money is accruing tax deferred, and ultimately, when dispersed per the plan stipulations, it's dispersed tax-free. It for anyone who has excess monies and can afford to do that for a child or grandchild, it certainly is a very wonderful gesture. But in the case of a younger, I think, couple who are still anticipating children going to college, we wouldn't suggest compromising retirement plans, in order to fund 529 plans. We think that planning for retirement comes first. Planning for one's own financial security is always the core focus. And then whatever is left on the table then can be applied in these other areas like 529s. Children where you have the ability to, put your kids through school, it's a great thing. But ultimately, later in life, you don't want to have to go to them for financial assistance. So we have to just keep our priorities in order.
Yeah, you said something when we first started working together that's always been in my mind, that you can always borrow money for school, but you can't borrow money for retirement. And I agree with that. Now, there have been two major changes to 529 plans in the last, I think, 10 years. I think both with different versions of the Secure Act. One, the first one, made it possible for people to use a portion of a 529 account for elementary, middle, and high school private education. That was not available before. It was only for higher education. So that's some flexibility that didn't exist before. The other big change is more recent, where up to $35,000 can be rolled over someone's lifetime into a Roth IRA. Now, this is for the beneficiary of the 529. So let's say Bob sets up a 529 for Kimberly. Kimberly, she goes to school, she doesn't use it all. Maybe there was 50,000 in there and there's 20,000 left over when she's done with school. So if that account has been open for a certain amount of time, Bob can transfer or roll a portion each year of that balance into a Roth IRA for Kimberly. It's a really nice feature that helps to reduce the risk of you overfunding a 529 account, because that's part of the concern is, what if I put too much in? Well, then if you pull the money out for something other than educational reasons, there may be a penalty and income tax on the growth. And so people have been concerned about that for a long time. So this is a nice feature that reduces some of that risk. 529 accounts can also, the beneficiary of those can also be changed to another family member, like a sibling. And so some families they won't necessarily have a 529 for each of their kids, especially if there's an age gap. They might set up 529s for older kids, fund them in such a way that there's less concern that they won't be able to use them for later kids. So we still think, like any investment, time is your friend. So if you're thinking about setting up a 529 for a 17-year-old, the benefits are more limited because there's just not very much time. But if it's a newborn a small child, it can be really, really helpful. And there's something that we've used for our own family. So we're fans. Still. Any other questions before we wrap up? Again, we're happy that you're here. We're happy that you took the time. Grateful for your trust on a Tuesday afternoon is this the dog days of summer? I think. I don't remember what exactly.
They're hot.
They're hot. So anyway, we're glad you're here with us and appreciate your time. If there are other things you'd like to discuss or other questions you have, please let us know. Otherwise, we will adjourn for today and plan to talk to you again soon. Thanks for watching.
Thanks, everybody.
Take care.